Have you ever seen a company where the numbers look absolutely fantastic, but the stock market just doesn't seem to care? Well, today we're diving into a real head-scratcher. We're talking about a cosmetics firm called Warpaint London, and its story is a perfect case study of a company that looks great on paper, but gets a surprisingly cold shoulder from investors. Let's get into it.
So here's the puzzle right up front. On one side, you've got a business that is, by all accounts, firing on all cylinders. We're talking great growth, really solid profits, and a balance sheet so clean you could eat off it, practically zero debt. But then, on the other side, you look at its stock price, and the market has it sitting on the bargain rack. It's a huge disconnect. And the big question is, why?
Okay, so we're going to break this all down. First, we'll dig into the story the company's financials are telling us, the story of strength. And then we'll look at the very different, much gloomier story that the stock market seems to be buying into. So who is Warpaint London? Well, they're a cosmetics company out of the UK. You've probably seen their affordable brands like W7 and Technic on the shelves of major retailers like Tesco and Boots. The bulk of their business, about 64%, comes from their own brands. But they also have this interesting closeout side business where they sell excess inventory. And they're not just a local player. They're pushing hard into the global market.
All right, let's start with the good stuff. Let's look at the hard evidence for just how strong this company really is, because honestly, when you look at the financials, they're pretty darn impressive. First up, let's talk return on equity, or ROE. Warpaint is clocking in at an incredible 25%. Now, what does that mean in plain English? It means for every dollar of shareholder money they have to work with, they generate 25 cents in pure profit. That is a sign of an incredibly efficient and profitable business.
And that profitability trickles all the way down to the bottom line. Their net profit margin is nearly 15%. So for every $100 in sales they make, after paying for everything, and I mean everything, they're left with almost $15 in cash profit. That is a really healthy margin. But here's the real kicker. A lot of companies borrow heavily to fuel their growth. Not Warpaint. Their balance sheet is ridiculously clean. In fact, they have more cash sitting in the bank than they have total debt. That's what we call a net cash position, and it gives them unbelievable financial flexibility and safety. And if that wasn't enough, they share the wealth with their investors. The forward dividend yield is sitting at nearly 6%. That's a fantastic cash return that gets paid right into your pocket. So from just about every financial angle you look at it, this company seems like an absolute rock star. Which, of course, brings us to the other side of this mystery. If the company is so solid, why is it so cheap? Let's take a look at how investors are actually valuing this business, because it seems like a case of excessive punishment. Okay, to really get this, we need a quick look at a ratio called EV to EBITDA. Now, don't get hung up on the alphabet soup. Just think of it as a price tag. It compares the total value of the company to the cash it's earning. It's a great way to compare apples to apples in the same industry, and here's the key. A lower number means the company is cheaper. And this is where things get wild. Look at this chart. Warpaint London is trading at a multiple of about 6.5. Its direct competitors, they're trading at an average of 15. That's not just a little discount. The market is basically saying Warpaint is worth less than half of what its peers are, even though it's making great money. This really is the million-dollar question, isn't it? Why on earth would a company with such solid profits and a fortress balance sheet be getting treated like this by the market? Well, the analysis points to one big culprit, the market's obsession with the short term. See, even though Warpaint's growth for the full year was strong, they had one single quarter where profits dipped pretty significantly. And for a market that is often laser-focused on what's happening right now, a scary number like that can cause a panic, completely overshadowing the much healthier long-term picture. So what do we do with this? We've got to weigh the scales. Is the market being smart and seeing risks we don't? Or is this a massive overreaction that creates an opportunity? Let's lay out both sides of the argument. Okay, first, let's be real about the risks. The cosmetics world is a battlefield. You've got giants like L'Oreal and trendy players like ELF Beauty. Plus, makeup is something people might cut back on when the economy gets tough. And of course, there's inflation, supply chain issues, and the fact that they rely on a few big retailers for their sales. These are all totally valid concerns. But then you flip the coin and look at the opportunities. They're just getting started on a huge international expansion into markets like the US and Asia. That could be a massive growth engine. That high dividend we talked about, it pays you to be patient while you wait. And that debt-free balance sheet means they have the cash to go out and buy other companies to grow even faster. And it's not just a hunch. Check out this quote from one analyst estimate mentioned in the source material. They calculate that the stock is trading almost 50% below what they believe its fair value is. That's a huge stamp of approval, suggesting that at least some of the experts think the market has got this one dead wrong.
Okay, let's put all the pieces together now. Based on everything we've seen, what is the core case here for Warpaint London? What's the thesis?
The case laid out in the analysis is really a classic cheap company argument. You start with step 1, a fundamentally great business with good profits and solid growth. Step 2, an incredibly safe financial foundation with more cash than debt. Step 3, it pays you a generous and growing dividend. And step 4, you get to buy all of that at a price that seems to have been unfairly hammered by the market over a short-term hiccup. Now, the analysis is also pretty clear that this kind of situation isn't for just any investor. It's really best suited for someone who's patient, who thinks long-term, and who cares more about the underlying value of the business and its dividends than the stock's wild day-to-day swings. And that really leaves us with the big, final question at the heart of this whole thing. A company like Warpaint London is the perfect example of a clash between hard data and market emotion. It forces you to ask, when the numbers are telling you one thing, but the stock price is screaming something completely different, which story do you choose to believe?